So these are the disadvantages here. So next what we look at is about the headings of cash flows. Okay, so the first one is operating activities. Okay, there are like three activities. One is operating, one is financing, another one is investing. So first we look at the operating activities. See, operating cash flows which must generate cash inflows to pay all cash outflows. So this is the most predominantly cash generating part of a company. Most of the components of cash flows from operating activities will be those items which determine the net profit or loss of the enterprise. That is, they relate to the main revenue producing activities of the enterprise. See, by nature, operating activities part of the cash flow statement should be the biggest. Okay, it should be consistently the positive cash generating part. Okay, if it's going to be like consistently cash losing activity, okay, then the company would be like in term going towards bankruptcy. The standard gives the following as examples of cash flows from operating activities. So these are the things that are included in operating activities. Okay, cash receipts from the sale of goods and rendering of service, cash receipts from royalties, fees, commissions and other revenue, cash payment to suppliers for goods and services, cash payments to and on behalf of employees, something like salary. And we'll see like how a real cash flow statement will look. So this will give you an idea, but don't worry about the detailedness of the real cash flow statement. Okay, in real problems you won't have like so complexities. So we'll just look at here. So this is a cash flow statement. So you can interchangingly use the term cash flow statement or statement of cash flow. Okay, that doesn't matter. So you could see here, this is profit before tax and it is being adjusted for depreciation, interest income. Okay, and depreciation is an expense, so it is added back. Interest income is an income, so it is deducted. All right, so dividend income is deducted. Why are these deducted? Why these two things are deducted is interest income is a investing activity, so it should not come in this heading. Dividend income, again, it's a investing activity, so it should not come here. Okay, finance cost is again added back. Okay, finance cost is added back. Usually finance cost will come, but it will come after this operating profit before working capital. After this it will come, so they are like deducting that number, so that what they want ultimately is the operating profit. Okay, they want the operating profit before working capital change. So look at here, bad debits written off, that's like taken out. Allowances, provisions, that's taken out, because allowance and provisions are not a cash flow activity. Okay, so anything which is not a cash flow activity is taken out. Any gain, any gain made is a income, so that is deducted out. Okay, so this is how, so you don't, in exam you won't have this many length of items. Okay, you will have like a little bit lower items. And once you get operating profit from before working capital changes, then you adjust the working capital. For example, if you see this company, okay, this company has decreased its trade receivables, okay, by 116 when compared to last year. This year it is the trade receivables has been decreased. That means more cash has been received from your debtors. Okay, so that is a good thing. That's a good thing. So add that back. Okay, so for example, anything else we could see here. This one is a decrease in trade payables. So this company is like paying a lot of their payables or outstanding expenses they're paying. So that leads to they are quickly paying. So cash is going out of the company. Okay. So with this, finally the company deducts the income tax. Okay. They deduct the income tax and finally they get the number net cash generated from operating activities. Okay. So just have an idea here. It's not that you have to detailedly remember them. You can also have an idea about cash flow from investing activity where the company has invested. So you could see here, purchase of property is a cash outflow, sale of property is a cash inflow, payment for acquiring the rights of use of an asset, something like a royalty. Okay, so that's a payment, so it's a negative cash. See, purchase of non-current asset, purchase of non-current investment, sale of non-current investment, purchase of term deposit. It's an investing activity. Interest received, what we deducted there, interest received, that is like added back here. So interest income was 41.67, which was deducted there. Okay, should come here. Okay, so you could see here the same number 41.26 is here. Any dividend received from other companies is usually added here. Okay, so if there's any dividend income there, okay, it's 34.7, that should be added here. So if you add this, I think it comes to 34.73. And the last one is cash flow from financing activities. You could see how the company is like financing. Okay, the company has paid a huge amount of dividends. Okay, the company is like paying huge amount of dividend and dividend tax paid. So that is their investing part. So that comes to a huge number. Okay, any finance cost paid comes here. Okay, any finance cost paid, it comes here. That's like interest. Okay, so that's about it. So interest can either come here. Okay, in textbooks, if you see, interest is usually comes here. So this interest, if it's here, finance cost, yes, see, interest which is like added back here, usually it is again deducted here itself. Okay, so there's an option to show interest either in operating activity or in finance activity. That's our choice. That won't be a problem. But usually in textbooks they show it only in operating activities. Okay, see, what we are like mostly bothered here is about that last total heading. Okay, not about the small movements here. We are mostly bothered about the total movement. So see here, this company has generated 2400 crores of money from operations from their business and has invested, okay, around 774 crore worth of money, and they have also paid dividend, which is a huge number. They have paid as dividend. Okay, so if you take these three numbers, they have generated 2400 crores of business income. They have spent 700 crore of investing in activity, so balance is 1700 crore, and they have spent 2100 crore for paying dividends. Okay, as part of financing activity, they had only 1700, so 2100 means 400 is the decrease in the cash position. Okay, because of the decrease in cash position, look here, their opening cash was around 1100 crore. They have used out of that 400 crore. The balance now has reduced to 693 crore. Okay, so is it a bad thing? It's not a bad thing. The company seems to be having excessive cash and they are returning back it to the shareholders. Okay, so that's about the concept here. You should know how to work out the statement. You should also know whether in real life, whether it's a good thing or a bad thing that the company is like generating different headings of cash inflow and outflow. Okay, so that's what we are like majorly concerned about. Okay, so this is a breakup of that money. Okay, so this is the opening cash and this is the closing cash and the cash equivalents. So look at here, like from where the money has like moved. So the company predominantly had liquid mutual funds, so that they have sold and they have reduced and they have taken the money from there, and they've also they have increased their cash position. Okay, cash position has moved from 100 to 300 crore. Okay, they've also increased current account, they have also increased cash account. Okay, they've increased that, but predominantly they have reduced their deposit, checks, everything they have liquidated. Okay, this is not like very important, and this doesn't form a part of a problem also. Okay, so this is not much of a importance, but it tells you like where the cash is moving from which account to which account. So that's about the theory part of statement of cash flows and the real life statement of cash flows. Okay, hope you learned a lot. Thank you very much. We'll meet in the next video.